Welcome back. In this lesson, we shall go through the basic features of a bond. We shall examine the basic features of a plain vanilla bond, followed by a quick overview of bonds with other types of coupon structures. Let's get started. The plain vanilla bond is said to have a bullet coupon structure. A bullet structure is characterized by fixed coupon payments and a final payment that includes the principal payment and a coupon payment. This final payment is also known as the balloon payment. In such a structure, all the principal is repaid on the maturity date. However, not all bonds are structured this way. Some bonds are structured such that principal payments are repaid throughout the course of the bond. For example, the bond can be structured such that the bond issuer pays out $275.49 half-yearly to the bondholder. Part of the amount is principal repayment, and the rest is interest payment. Does this look familiar to you? Your home loan is probably structured this way as well. We call this a fully amortizing bond. A bond can also be partially amortizing. As in this case, the bond issuer repays $150 per month. Part of it is interest payment, and the rest is principal payment. The final payment at maturity is a balloon payment of the final interest and the remaining unamortized principal amount. Out of these three fixed payout bonds, the bullet structure is by far the most common. However, one issue with bullets is that the balloon payment at maturity is much higher than the periodic interest payments. This exposes the bondholder to a higher level of credit risk. The credit risk is simply the risk that the borrower has insufficient funds to pay its obligations. For bonds with longer maturity, the credit risk is higher. This is because the longer the time frame, the higher the chances of something going wrong with the finances of the user. To make long-dated bonds more attractive to investors, bond issuers can include sinking fund provisions. For example, a 15-year issue with a face amount of $100 million can have a sinking fund provision that requires the borrower to retire $10 million each year, starting from the 6th year. So, for the first 5 years, the par value of the outstanding bonds is $100 million. From the 6th year onwards, the amount of outstanding bonds should be lowered by $10 million each year. There are two ways the borrower can retire the required amount of bonds. It can either redeem the bonds from randomly selected bondholders at par value, or buy back the bonds from the open market at the market price. If the market price goes below par, the bond issuer is more likely to buy the bonds from the open market at the market price. This may have the effect of increasing the market price, which will make the bondholders happy. However, the bondholders may not be happy if the reverse happens. If interest rates have fallen since issuance, the market price will likely be higher than par. The bond issuer is more likely to redeem the bonds from selected bondholders at par value. Imagine if you're the bondholder. You may get very mad because you're only getting back the principal, rather than the higher amount that you can sell in the open market. So far, we've learnt the bullet, fully amortizing, and partially amortizing coupon structures. All of them have a fixed coupon structure which is determined at issuance. Some bonds, however, pay variable interest that depends on the current market rate of interest. Such bonds are called floating rate notes, or floaters. Floating rate notes tend to be structured such that there is a specific market rate of interest, also known as the reference rate. For example, we specify this bond to have the 6-month LIBOR as the reference. An interest margin is usually added to compensate the lender for the credit risk that the lender undertakes. Added margin is typically expressed in basis points, which are hundredths of 1%. A 150 basis point margin is equivalent to 1.5%. So for this case, if the 6-month LIBOR rate is 3.0% today, the coupon rate to be applied 6 months from now will be 4.5%. Remember that this is the annual rate, so we have to divide the amount by 2. So 6 months later, a coupon of $22.50 is paid. Now let's say the 6-month LIBOR drops to 2.0%. Are you able to calculate the coupon payment at the 1-year mark? Pause the video now and work out your answer. And we're back. Adding the interest margin of 1.5%, the coupon rate to be applied is 3.5%. Dividing by 2 and multiplying by the principal of $1,000, the coupon payment at the 1-year mark should be $17.50. So you get the idea. The coupon payment is based on the LIBOR rate at the beginning of each period. On the maturity date, a balloon payment of the final coupon plus the principal amount of $1,000 is paid. A floating rate note may have a cap, which benefits the issuer by placing a limit on how high the coupon rate can rise. If the coupon rate rises higher than this cap, the cap rate is applied instead. Often, floating rate notes with caps also have a floor, which benefits the bondholder by placing a minimum on the coupon rate. Regardless of how low the reference rate falls, the floor rate is applied to protect the bondholder. In essence, floating rate notes have coupon payments that correlate with the reference rate. However, that does not always have to be the case. An inverse floater has negative correlation with the reference rate. The coupon rate increases when the reference rate decreases, and decreases when the reference rate increases. In fact, the reference does not have to be interest rates. Index-linked bonds are another class of bonds in which the coupon rate is based not on interest rates, but indices. The base index can be a commodity index, equity index, inflation index, or any published index. In particular, inflation-linked bonds, also called linkers, are the most common type of index-linked bonds. The payments for an inflation-linked bond is based on the change in an inflation index, such as the Consumer Price Index in the US. They are designed to protect bondholders from the effects of inflation in eroding the purchasing power of their principal. You should be aware that index-linked bonds can be structured in a number of different ways. Interest index bonds have their coupon rates adjusted for inflation. The principal remains unchanged throughout the tenor and is fully repaid on maturity. Indexed annuity bonds are fully amortizing bonds in which the principal is progressively repaid. The periodic payments are directly adjusted for inflation or deflation. Index zero coupon bonds pay no coupons throughout the tenor of the bond. They are sold at a discount from the start, and principal repayment is adjusted for inflation at maturity. Capital index bonds have their principal adjusted throughout the life of the bond based on the inflation index. The coupon rate is a constant percentage of the principal, and because the principal is changing, the coupon payout for each period is also different, depending on the inflation index. At maturity, the principal, adjusted for inflation, is repaid. To elaborate, let's consider a capital index bond of 2 years tenor, $1,000 par value, with a coupon rate of 4% that is paid out half yearly. The principal at initiation is $1,000. Let's say the Consumer Price Index increased by 1% in the next period. The principal will be adjusted to $1,010. The coupon payment for this period will be half the fixed coupon rate, which is 2% of $1,010. A coupon of $20.20 is paid out. This continues for the rest of the payments. At maturity, if the total change in the Consumer Price Index is just 0.5%, the principal is adjusted to $1,005. This amount is paid to the bondholder plus the last coupon payment. Capital index bonds are, by far, the most common type of inflation-linked bonds. A well-known example is the U.S. Treasury Inflation Protected Securities, or TIPS. Besides interest rates and indices, the coupon payments for a bond can also be determined by the credit rating of the issuer. Such a bond is called a credit-linked coupon bond. The coupon rate is inversely correlated with the issuer's credit rating. If the credit rating goes down, the coupon rate goes up. Conversely, if the credit rating improves, the coupon rate goes down. While this offers some protection against a credit downgrade of the issuer, the higher required coupon payments may make the financial situation of the issuer worse and possibly increase the probability of default. Another form of coupon structure comes in the form of step-up coupons. Step-up coupon bonds are structured such that the coupon rate increases over time according to a predetermined schedule. For illustration, this $1,000 par 15-year bond has a base rate of 4% and a step-up in interest of 1% and 2%, beginning on the 6th and 11th year respectively. In the first 5 years, the base coupon rate of 4% is applied. This works out to a coupon of $40 per year. For the next 5 years, the stepped-up coupon rate of 5% applies, which works out to a coupon of $50 for each year. And for the final 5 years, the coupon rate is increased to 6%, which is $60 per year. Typically, step-up coupons have a call feature that allows the firm to redeem the bond issue at a set price at each step-up date. This feature can offer bondholders some protection against rising interest rates. To illustrate, consider a bond with just a constant coupon rate. When market interest rates rise, the issuer is unlikely to call back the bonds as it is cheaper to pay the interest for this bond than to refinance with new borrowings. Now, imagine if you're the bondholder. You may not be too happy because you're stuck with this bond, which pays a lower interest than the market rate. However, if this is a step-up coupon bond, the provision allows the bondholders to receive a higher coupon, more in line with the higher market interest rates. In some cases, the issuer may be more inclined to call back the bond. This will certainly make the bondholders happier. Another type of arrangement is the deferred coupon structure, also called a split coupon bond. This is one where the issuer only starts making regular coupon payments from a period of time after issuance. As with most other bonds, the full balloon payment of the principal plus the last coupon is made on the maturity date. Deferred coupon bonds are issued by firms that anticipate that their cash flows are insufficient to make coupon interest payments. For example, a property developer financing an office tower construction project may anticipate that it'll only have sufficient revenue to make payments after the completion of the project. Therefore, the bond is structured such that it only starts payment after the estimated completion of the office tower. One special type of a deferred coupon bond is the zero coupon bond. As its name implies, the bond pays no interest prior to maturity. Also known as pure discount bonds, these bonds are sold at a discount to their par value, and the interest is all paid at maturity when bondholders receive the par value. For example, a $1,000 par 2-year zero coupon bond can be sold at a discounted price of $900 at issuance. The price of the bond will drift up to its par value of $1,000 as the maturity date nears. The yield to maturity of the bond at issuance is the discount rate that equates the discounted price to the present value of the par value. Solving for R, we get a yield to maturity of 5.41%. Alternatively, you can use your time value of money calculator to solve this. Another type of bond that does not pay regular coupons is the payment in kind bond. Unlike the zero coupon bond, the bonds are not sold at a discount but issued at par. The bond issuer pays coupons in kind by increasing the principal amount of the outstanding bonds. Payment in kind bonds are typically issued by firms that may not be confident of meeting regular coupon payment due to limited cash flows. These bonds typically have higher yields because of their lower perceived credit quality, and also to compensate the investor for the higher credit risk. And that concludes this introductory lesson. We've learnt the 5 main basic features of a bond, plus the various types of coupon structures. In the subsequent lessons, we shall look at the legal, regulatory, and tax considerations for bonds, as well as the contingency provisions. See you again.